So, welcome to those who just joined. It's now time to launch the first EnergyScan webinar session of 2023. I'm Julien Waro. I'm in charge of the EnergyScan platform here at NG Global Energy Management and Sales. So first, I would like to wish you the best for this new year from the whole EnergyScan team here in Paris. Do note that this session will last 90 minutes to cover all the topics and give you some time to ask questions. So 2023 is another year of uncertainty for energy markets in the aftermath of the historical surge in wholesale energy prices last year. We'll try to figure out what are the key trends for financial markets and the European energy landscape for this new year with our first speakers, namely Olivier Gasnier, Évariste Nouki, and Étienne Covin. 2023 will also be a very special year from a regulation point of view, with some major regulatory changing entering into force. And that's why I'm delighted to welcome two of our key experts on this topic in the second part of the presentation, namely Cyril Harry, who is the head of gas asset regulation and analysis, and Hélène Robet, who is the head of power regulation and market design. So, as usual, we'll start with macro and oil trends before switching to gas and power issues, and we'll conclude, as discussed, with key regulatory moves for European gas and power markets. So let me remind you that this is an interactive session. So don't hesitate to use the chat module to ask questions to our speakers. We'll do a short Q&A session at the end of each presentation. And finally, you will be asked to fill a 30-second satisfaction survey at the end of the sessions. And note that the slides and a replay of the session will be available by tomorrow at the latest on our EnergyScan platform. So it's time to move on to the first part of this session with macroeconomy and oil with Olivier Gasnier. Olivier, the floor is yours.
Hello, Julien. Hello to all of you, and thank you for attending this webinar. Let's start for once with oil. We can see that prices are back to their pre-war levels between $80 and $90 per barrel for the Brent. Prices were driven up by fears of an oil shortage at the beginning of last year, of course. But Russia has managed to redirect its supply to Asia, and even the European crude embargo that started in December has not had a significant impact on prices. And the contango structure of the short term of the forward curve, and you can see that on the right on chart, shows that the market is no longer worried about supply. In addition, the very strong monetary tightening by central banks has fueled the fears of recession. Today, volatility is very high on the oil market because the risks are balanced. In the short term, there is on the one hand the COVID crisis in China, you have this versus the upcoming embargo on Russian oil products that may have a deeper impact than on crude oil. If you look at the longer term perspective, a recovery in Chinese demand on the one hand, on the other hand, you have fears of recession in the US and Europe, and of course, I will come back on that subject. So at the moment, we can see that prices are rather up. We are nearing $88 per barrel for the Brent. That means that bullish factors are dominating at the moment. Because as you have seen more generally on markets, there is really more optimism about the economic situation and the fact that in particular European economies have been resilient to the rise in energy prices. I'm not going to spend time on this slide. You can find this slide in our latest monthly report. It's just to show that we don't expect any strong price movements for this year. I'm not saying we will be right. I mean, we may be wrong, especially if the Chinese demand really surprises on the upside. We could have a stronger oil prices, but it's just to it's necessary to be clear about the fact that we have taken into account in our forecast rather stable oil prices, and we don't expect, you will see that with inflation forecast, in our forecast, another surge in oil prices that could explain why inflation remains quite high. So let's talk about inflation. Inflation has started to fall from mid 22 in the US at the very end of the year in Europe. It's easy to understand what made the difference between the US and Europe. It was essentially gas prices that were extremely high, with consequences on power prices during the summer. The energy components alone accounts for 3 percentage points of the fall in US inflation. You can see that on the right hand chart, which shows the contribution of energy to year-on-year inflation. So that means that it's more than what we have observed in terms of fall in the total inflation in the US. If you look at the Eurozone situation, 80% of the decline over the last 2 months has come from energy prices. And that will continue. As I told you, if we assume that energy prices are rather stable, inflation will fall by another 2.5% in the Eurozone by mid-23, and by 2 points more in the US. So that we can probably expect US inflation to fall below 4%. By June, the deceleration will be a bit slower in Europe. So now if we look at the inflation forecast, once again, it's something that you can find in our monthly report. What does it show? It shows a sharp fall in 23 in terms of average evil. You can see for the US, 4% instead of 8%. For the euro area, 5.8 instead of 8.4, for example. But still, we have very high levels at the end of the year, well above central banks' targets, which are say between 2 and 3%, because the energy impact will be extremely strong in the first part of the year and should diminish or even reverse during the year, with still this difference between the US and Europe, because you will have a more favorable effect in Europe in the second part of the year due to gas prices, normally, of course. Core inflation will also be resistant. And that should prevent a rapid fall in inflation, and I will give more details about that. Actually, the situation on core inflation is quite complicated. Core inflation trade are what matters to central bank. That is what will remain at the end of the day. In the US, it has started to fall last month, core inflation. So that means excluding energy and food, the most volatile price components. So core inflation fell from 6% to 5.7%. But if you look at service prices, and you can see on the two charts on the right, the contribution of each component to total inflation, you can see the very strong component contribution of services in the US, because they have kept on accelerating to around 7% on a year-on-year basis. So services, it's mostly wages, I would say, plus, of course, the impact of other prices that are spreading into the other part of the economy. So you have also in the US a specific factor, which is rents, and they are contributing to a very strong inflation. But as the housing market has already turned around, it's reasonable to think that it will calm down. If you look at wages, it's more complicated because wages, we have also seen a start of a deceleration in December. But if you look at other indicators on the job market in the US, they point to a recovery, which is quite strange at this period of the cycle. But for example, jobless claims that you have each week, they are clearly on a downward trend for weeks now. And that points to a kind of reacceleration on the job market, which is quite strange. More generally, this is very important. The states of labor market will be a key factor to explain why, in my view, inflation should be resistant on the downside. Because everywhere, including in Europe, you have unemployment that remains extremely low. In the Eurozone, you can see that the consequences of the war has been the most visible on energy and food prices because of the direct consequences of the war in Ukraine. But the diffusion of these rising costs to the rest of the economy will be, of course, all the easier as the economy resists on wage demands are strong. So if I try to sum up all this, we can say that core inflation is starting to slow down a bit, but the situation is very complicated. There are more tensions in the US, but you have also a downturn in the housing market that should help core inflation to come down. But more importantly, you have to keep this factor in mind, the fact that labor market remain very tense and should contribute to still a strong core inflation. Okay, so if the situation is a bit complicated on inflation, maybe it's a bit simpler on growth, and actually it's not really the case. The Chinese economy has slowed down sharply in Q4 2022. Actually, the GDP was stable, which was quite a good surprise after the abandonment of restrictive health measures and the surge in the COVID cases at the end of 22. If you look at the US, GDP growth has been quite strong, probably in Q4, because expectations are still around 4% on a quarterly annualized basis. But if you look at the latest trends, they are clearly negative. And especially, we have seen a plunge in the purchasing manager indices. And if you look in particular to the ISM in the service sector, it has been not that low since the financial crisis and the COVID crisis, so quite negative. And finally, if you look at the Eurozone situation, the Eurozone has defied all the pessimistic forecasts to probably avoid recession this winter. Why I have chosen this chart? It shows how the economic indicators of the three main countries or economic zones have surprised or not. This is an economic surprise, and you can see very good surprises for Euro area, very negative surprise for China, probably with an inversion of trend starting yesterday with this freeze of GDP figures, and the US slightly negative. So here we have very big divergences that makes the situation quite complicated. So the situation, this leads to a question about the recession. If China has started to recover after the surge in COVID cases, if the euro area is holding up very well, can we expect to avoid a recession? What the bond markets are telling us is really the opposite. The main reason is that, in our view, that the negative impact of monetary tightening is completely underestimated. So monetary tightening is coming to an end in the US, as you can see on the left-hand chart. It shows that the peak Fed funds rate is nearing. It's a bit. It's not finished in Europe, but we also expect the trend to reverse in the course of 2023. But at the end of the day, what matters is that monetary tightening is of a magnitude not seen for 40 years. We are talking about rate increases of 4 to 5 percentage points in less than 12 months. This is absolutely huge. It has not been seen since the start of the 80s. On the rate curve of inverting, as you can see on the middle chart, shows the spread between the 10-year and the 2-year rates. That means the 2-year rates are now clearly above the 10-year rates. And it's also the case for the difference between the 10-year and the 3 months. Clearly, there is a big negative spread right now. So this is what we call an inversion of the yield curve. And if you look at the what happened on a very long period in the US, you can see that such an inversion of the yield curve has always been followed by a recession. So this is really something that has to be kept in mind, and of course, this is linked to the negative impact of the monetary tightening on GDP growth. Last slide that you can also find in the monthly report about the economic forecast. But with what I just said, you have understood that in our opinion, we should not expect any miracles in 2023. Either the economy weakens quite rapidly and we have probably a mild recession in the US, either it resists and the condition for strong core inflation are there, so monetary tightening should continue, and probably the recession will come later, but probably also stronger. So this is the conclusion of my my presentation, and I'm ready to answer some questions if you want, Julien.
Yes, thank you, Olivier, for this presentation. One question regarding the Euro USD rate. When can we expect for it in 2023?
Yeah, the euro dollar is currently on an upward trend. Very recently, we were below the parity, and the expectations were quite negative, but now we are more than 108. So markets are positioning for more gains now. There are two reasons for that. The first one is the fact that the interest rates spread between the US and Europe is reducing, because of course you have expectations that the Fed is near the peak of its rates, while probably for the ECB it will take some more time, because of course the ECB starting hiking rates later, and we had confirmation of this morning with the governor of the Bank of France saying that several increases of 50 basis points were still on the table for the ECB. And the second reason is that in an environment where risk appetite dominates, you have an environment that is not very favorable for the US dollar. The US dollar is a safe asset. When things turn ugly, the people will tend to buy more dollars. So we agree with this idea that the euro dollar should continue in the short term to increase. In the medium term, if you look at the second half of this year, for example, if, as I think, the recession will materialize in the US, you could think that should benefit more to the euro. But actually, I think that that will mean that all the global economic situation will deteriorate, even if there is a a big if that I didn't mention in the last slide, and I should have done that. Even if we bet on a Chinese rebound, that will probably soften the negative impact of a US recession on the rest of the world. That is something to have in mind. But so if I come back to what I was saying, if you expect a US recession that will spread its effect on the rest of the world, this should be positive for the dollar because of the risk-off environment, if you want. So in that case, that would probably trigger some downward correction in the euro dollar after an initial rebound.
Okay, Olivier, there is a question about China in the chat. You partially answered, but I will share it with everybody. So, is there a debt crisis risk in China in 2023? And could China growth be impaired by the recession expected in US and Europe?
Yes, clearly there is a big problem in the housing market. Housing prices, they continue to fall in China, and this has been the case for 1 year and a half. So that the situation is very complicated. There have been several plans to support the housing sector, but they have not been very efficient, or at least that just limited the fall so far. So that is something that will probably reduce the potential for economic rebound in China. I mean, of course, yes, the Chinese rebound will be will be weakened. The potential for a rebound will be weakened by the fact that exports shouldn't be that dynamic if you have the US and then Europe falling into a recession. But I would tend to adopt a more optimistic view and say that China should contribute to limit the negative impact of US recession on the world in 2023.
Okay, thank you, Olivier. It's now
Welcome.
time to move on to the gas and power part with Évariste and Étienne Covin. Hello, Évariste.
Hello, thank you, Julien. Hello, everybody.
You can start.
So on gas, let's start by looking at the European Union gas balance during the last 5 years. Clearly, when you look at the values for 2022, you see clearly that the loss of Russian gas was compensated by a higher LNG supply and lower local demand. The question now is to see if this will be the case this year. To answer this question, we have built a set of scenarios, and we focus mainly on 2 items which we believe are the most uncertain. Clearly, LNG supply and also local demand. On the table, LNG supply is almost equal to LNG send out. So for those 2 uncertain items, you have a central value, which is the value for last year. And around this central value, we set 2 values, an extreme one and a high one and a low one. For all the other items on the supply demand side, we estimate that values will remain stable compared to 2022, except, and of course this is important, except for Russian supply. Russian supply, we expect it to drop this year to around 13 BCM, which is roughly the current values we are seeing in the market. And of course, this will lead to a significant drop around 49 compared to 2022. We have 9 scenarios, but we can say that 3 of them are a summary of all the scenarios. 3 of them, scenario 1, the most extreme one, to scenario 3, which is the most comfortable one, and in the middle you have scenario 2. When you have these 3 scenarios, you have almost all the likely outcomes. And it is important to note that scenario 1 does not lead to a sustainable equilibrium. Just because in this scenario prices are too high, that you trigger demand destruction and also a rebound in LNG supply, which is exactly what we had last year. Important also to notice that this scenario shows that in the very likely assumption of a stable Russian supply this year, effort to reduce demand should be maintained because LNG will not be enough to fill the deficit. So having this scenario, how do they translate into prices? We'll see it on the next slide. So to see the impact on prices, you have built two graphs on the 30th market, both one side on the left and your head on the right. Those of you who receive our publications are familiar with these graph. First, the idea is to explain gas prices via prices of oil and coal, their main competitors in the energy mix. On oil, Olivier mentioned that we expect maybe oil prices to rebound in the first half of this year, and then to rebound moderately, and then to drop in the second half. On coal, we expect prices to remain stable because even in case of a rebound in the Chinese economy, we believe that coal supply is comfortable enough to make the global coal market comfortable. So we have a rather stable outlook for coal prices, knowing that this is also what Chinese authorities want to ensure stable economic growth and also to balance profit between power generators and coal producers. So this means that overall gas prices should not find support from oil prices or coal prices this year. But the graph also shows some other interesting indicators. You have the 1 year average. Well, easy to know the 1 year average, just computing on a 1 year basis the average of daily prices. And around this 1 year average, we built what we call the 1 year low. You have the definition on the slide, which is just taking the average and then you subtract some volatility, and you have the opposite for the 1 year high. So those indicators, 1 year high, 1 year low, and 1 year average, are relevant for financial participants, which are also important participants in this gas market, because they set some buy and sell targets. So at the end, what we believe is that prices should trade throughout 2023 between the 1 year low and the 1 year average. Of course, these values are not stable. They should evolve along the year. And at the end of the year, when you look at the end of December 2023, we believe that the 1 year low should be around 20 and the 1 year average around 30. So this is our target price for the end of the year. And you see the gradual drop we expect if our scenarios are correct, and if the gas market, the European gas market, remain in between scenario 3 and 2 as we expect, we believe that by the end of the year you should trade around those levels. So that's it for me, Julien. I don't know if there are some questions.
Yes, we'll take questions right after the presentation of Etienne for gas and power at the same time. So Etienne, you can start.
Okay, thanks, Julien. Hello, everyone. Glad to see you all back for this new year, which should be quite interesting as well, actually. But as I have only a few minutes to talk about carbon and power, let's dig into the subject right away with a few words on the ETS regulation. Here. So, as you may have seen in December, the EU lawmakers finally reached provisional agreements on the Fit for 55 ETS revision and the REPowerEU package. So unfortunately, I don't have time to detail all the subject, but just to let you know, you can find on EnergyScan a full report on the matter presenting the measures adopted and their impact on the market balance. But all in all, there are two things to remember from this. First, the measures agreed on came mostly in line with market expectations. So the market's reaction, and by that I mean the prices, have had a rather muted reaction. And now that the decision has been taken, the implementation part of the process should be at the center of focus, but should have a much weaker influence on carbon prices. Secondly, although most policy risks are now removed with the agreements, there are few uncertainties remaining. And among them, one to monitor in the coming weeks will be the actual volume of e-waste to be front-loaded as part of the REPowerEU plan and the start date of the sales, both of which should be determined by the European Commission in the coming months. So, of course, the market is likely to have already priced in the additional supply from REPowerEU, but still some volatility could emerge when the auction calendar will be updated. And since lawmakers decided to support equal annual volumes, the later the sales will start, the higher the volumes will be in 2023, and hence the stronger the pressure on prices will be. And it's a good transition because speaking of prices, the EUAs have corrected recently from their mostly speculative and option-led bullish run initiated at the end of last year and are now hovering close to their early November level. But what can we expect this year? Well, overall, and this is illustrated by the bottom chart, the market will remain short in 2023 due to the significant supply reduction from the annual cap decrease on one side and on the other, but the yearly withdrawal from the MSR. So you can see on the bottom chart that the market participants will once again have to draw on the market surplus, meaning that the supply will be lower than demand again in 2023. Nonetheless, prices are rather unlikely to surge again this year and hit fresh records like we saw early last year in 2021, and this for several reasons. Indeed, the demand is expected to remain curbed in the coming months, both on the industrial side due to the still high energy prices, even though we saw prices corrected in the past weeks, and on the financial one as a consequence of the higher interest rates and overall higher trading costs. Just to let you know that the investment funds started the year with a total net position near zero, which really highlights the lack of buying interest for them into the carbon market. Moreover, and even if it's already priced in by the market, the coming REPowerEU volume should still provide some pressure on prices when the sales will start and possibly a few weeks before. And finally, and Evariste already told you a bit about this, the recent sharp correction of gas prices has nearly driven the coal-to-gas switch price down enough for the most efficient gas power plants to be economically more competitive than the worst coal ones. So for the carbon market, what will be key to monitor in the coming weeks is if a further reduction of energy prices will trigger a rebound in industrial activity and hence overall emissions, or conversely, if the demand will remain lower than average and actual fuel switching will be able to take place, leading to a reduction of the expected emissions. Because as you all know, the gas-fired power production is always less emitting than a coal one. So all in all, we expect e-waste to trade range-bound again this year, likely between 70 and 100 euros per ton, as the market's negative balance will limit the downside, while the dampened demand and additional REPowerEU supply should prevent any other spike of prices. Two factors will have to be monitored closely in the coming months. One will be, of course, the recovery of gas and power prices, and the other will be if energy prices drop low enough to trigger some actual coal-to-gas switching. Conversely, the policy environment should have a much weaker impact this year. And that's all about carbon. Let's move to the power part of the presentation. So as you can see on the left chart, the power demand is still well below normal. And of course, the recent very mild weather and strongly limited the need for power, as you all know. But even when corrected from the temperature effects, which is showed on the graph, the demand remains significantly down from the historical average. So the chart presents the French power load, but you can see the amount estimated for the other NWE countries just below the chart. And an interesting point to notice is that most of the demand destruction seems to come from the industrial sector. But what about the supply? Well, regarding the French nuclear situation, the worst scenario has been avoided, even though EDF frequently delayed several outages throughout the past weeks. But as you can see on the right chart with the orange curve and the red curve, the availability remains quite well below the historical average, with only 40 gig reached early January. So 45 gigs are expected by February, but unfortunately, it's likely to be the maximum for this winter. Therefore, the outlooks remain rather bleak for the next couple of years, especially as EDF recently maintained its very low 2023 and 24 nuclear output targets, which are just above the catastrophic generations that we saw last year. And moreover, the utility recently warns that the corrosion issues that has been dampening the availability will have lingering consequences for the country in the coming months to years. Another interesting point to keep in mind is that our friendly neighbors in Belgium will see their nuclear capacity drop by 1 gigawatt as planned due to the closure of T2 reactors, which was already anticipated. So basically, so far we have been rather lucky as the lower than average demand has partly offset the very weak nuclear availability, but a strong recovery of demand could quickly tighten the market, which of course would have consequences on prices. A good transition to the prices slide. So you will be happy to hear that the power prices have plummeted since mid-December amid, of course, with pressure from the gas market, amid a very mild weather, a very strong renewable production, and as Évariste already presented you, sustained LNG import, which all limited the withdrawal from gas storages and reassured the markets. However, you can see on the right chart that the French prices still have a significant premium for the next 2 winters, which reminds us of the situation we had for this winter a few weeks back. And similarly, even though the situation remains comfortable, we could see the correction happen only later and very late, to be honest. So looking forward now, the power prices are clearly being dragged down by the falling gas contract since the recent mild temperatures, high LNG supply, and fuller than usual gas storages continue to pressure both markets. However, the downtrend might face some resistance in the coming weeks because no power nor gas demand recovery has materialized so far, as you saw on the previous slide. And furthermore, temperatures and renewable production are forecast to drop below normal for the remainder of January. So it's still not a sustained cold spell that is planned, but is still likely to limit the recent bearish pressure on the gas and hence the power markets. And meanwhile, the French nuclear availability nearly reaching its maximum for the winter should not help to the situation. So all in all, the currently bearish gas market remains in the driving seat of power prices, and the risk of supply crunch has significantly decreased over the past weeks. But let's not forget that winter is not over yet, and risks remain open for late 2024 and for the year of 2025. Regarding the risk now, if temperatures turn milder and the renewable production got stronger again, we could see prices head further down, of course. But conversely, if the LNG supply or Norwegian gas supply starts to weaken, if the industrial activity suddenly recovers, or if there is any sustained cold spell in Central Western Europe, both gas and power prices are likely to rebound towards their 1-year average. And that's it for the power and carbon market. Perhaps we can answer some questions on the energy markets now.
Yes, thank you, Etienne. We have several questions for the gas part with Évariste. If Évariste can come back. Hello, Évariste. You are on mute. Yeah.
Yes, okay, I'm back. But
Okay.
the question you are showing is the macro one, no?
Yeah. I'm selecting. We have several questions. So first question: what is your view on Chinese LNG demand? Do you expect a rebound later this year?
The simple answer is no, not really. Because I believe that even if you have a rebound in Chinese economy, they will first favor the use of coal. This has been the case in 2022, and I believe they should continue that policy. You have to know that China coal production is increasing strongly. We are talking about more than 10 percent increase. So they will continue to use coal massively and limit their import of LNG. So I don't expect noticeable rebound in Chinese LNG imports.
Talking about China's coal, can you elaborate a bit more on that? Wouldn't it be in the best interest of China to have lower coal prices, even if this meant lower revenue for coal producers?
This is also a good question, because I don't know if you remember in the presentation I talk about Chinese authorities' objective to have stable coal prices. This is really what they are trying to achieve, because stable coal prices means also stable power prices, because coal is mainly used to produce power. So stable coal prices, stable power prices, and then stable economic growth. So this is one of the goals. So when you think about this goal, of course, they have an interest to have low prices, but at the same time, they have to take care of their coal producers. So they don't want as well to their coal producers to be bankrupt. That's why the goal at the end is to have stable prices, to achieve the goal about economic growth, but at the same time to guarantee some comfortable revenues, acceptable revenues for their coal producers.
Okay, another question for you, Evariste, regarding Russian gas flows assumptions for 2023 and the coming years. So with Russian flows almost at zero from August 22, how does this supply forecast table look like in 2023 until 2025? LNG will offset Russian supply in full.
As I said, in the presentation, LNG will not be enough to offset the total loss, the loss of Russian flows. If you want the European balance to be comfortable, we have to maintain effort to reduce demand, because at some point, although we don't expect a significant rebound in China LNG imports, at some point you can have a rebound, maybe not significant, but you can have a rebound. And don't forget that you have also to monitor what will happen in Japan and South Korea and worldwide, because worldwide some other countries are increasing their LNG consumption, their gas consumption. So we cannot count only on LNG. We have to maintain the effort on demand. If it is not the case, for the years to come, the European gas balance could be really tight.
Okay, and just another question on coal. What do you think about the coal ban between China and Australia? Bearish impact or not?
Yes, recently, it was as early as January 3, Chinese authorities have decided to lift the ban on Australian coal. Now this opened the door for imports of Australian coal to China. But when you look at Australian prices, they are at a huge premium compared to prices for Indonesian coal or South African coal. So in the very short term, I don't expect a massive impact, because for Chinese buyers, it is still too expensive to import coal from Australia. Although you can have, yes, a kind of psychological impact, but when you look at the flows, I only expect some low flows to come from Australia to China.
Okay, so I just see a question regarding power price forecast scenarios. So just note that they are available in our EnergyScan platform and in our monthly report. So it's time to move on now to the next part of the presentation. So thank you, Etienne and Evariste, for your presentation and your answers. So Cyril, welcome, and you can start your presentation on the European gas price cap.
Thank you, Julien. Good morning, everyone. So the purpose of the next 15 minutes is to give you a glimpse on a new topic which may have a strong impact on the gas market design, which was extensively discussed at European level during months. And so the purpose is to share with you the most noticeable, let's say, provision and rules set by the European Commission just before Christmas on a new European gas price cap. So basically, what is, if we want to sum up at a glance, that new mechanism, which is called a market correction mechanism. So that new tool or make a scheme was introduced by the new council regulation, so dated 22nd of December. That regulation provides a series of emergency measures for the gas market, and one of them relates to this new gas price cap. So how this cap would be triggered, really briefly, so as set out there on the chart. It means that two criteria will have to be met before triggering that cap. And how it will work? First, if the TTF Dutch gas market on a month-ahead basis exceeds 180 euro per megawatt hour during 3 working days, so it will be the first criterion to meet. But, and it's a big but, it will not suffice, meaning that if in the meantime there is a gap between that month-ahead TTF price and the so-called reference price for LNG set or assessed at a global level by SR. If that reference price for LNG is more than 35 euro per megawatt hour lower than the TTF price during 3 working days, then you meet the second criterion, and then if both criteria would be met, it would trigger the implementation of the gas price cap on the TTF Dutch market. And then if we dig a bit more into the detail with regard to the exact scope, activation and deactivation rules of that cap, and what are the expected potential benefits seen from European institutions, is first that with regards to activation and deactivation rule, they are subject to quite, let's say, stringent or frame conditions. So first, the mechanism works as set out there on that, let's say, the left side of this slide. Just to bear in mind that probably some of you read through this kind of statement on the website of the European Commission, but some of them are a bit confusing. Reason for why in the following slides I will share with you more details on the exact activation and deactivation rules. But all in all, as it is explained by the European Commission, that cap would apply to transaction on virtual gas trading platform. By default, it will be limited to the TTF at a first stage. It will apply to months ahead, 3 months ahead, and year-ahead product. But, and it's a big but, that statement from the European Commission is not fully accurate because the exact scope in terms of maturity for the TTF product will range from months ahead to year-ahead product, meaning that all quarterly product would be onboarded in the, let's say, in the cap if triggered. What is fully clear and not subject to any confusion is that that mechanism is temporary, so only for a limited period of 1 year as from 15 February, so next month, and that the cap will be triggered if the 2 conditions I set out earlier will be met. So for the activation and for deactivation, the mechanism will be deactivated if there is a significant change in the gas price on the market, and if from a security of supply point of view, with regards to the physical balance at European level, if there is a regional or European emergency triggered or declared by the European Commission, for pure security of supply purposes, that cap, if activated earlier, would be deactivated. And that mechanism can also be suspended on top of deactivation conditions, meaning that if, for instance, there is some systemic risk stemming from the triggering of that cap, with potential instability, let's say, observed in financial market, if implementing that cap would hinder the gas demand reduction effort set by the European decision made earlier, or in general, if that cap applied to TTF would have some impact on cross-border flow within the European gas system, then if those phenomena are observed, the cap mechanism could be suspended. And in terms of benefit, so if you refer to the chart on the right side of the slide, basically that cap considering the two triggering conditions, so TTF exceeding 180 euro plus a gap between that TTF and the energy reference price exceed 35 euros, it means that if that mechanism would have been enforced, let us say 1 year ago, it would have only been triggered in August 2022, meaning that the cap would be applied only during the gas price peak period we faced in August and in early September, so at the end of the summer period. Apart from this very specific period, the cap, as defined today, wouldn't have been triggered on the bulk of last year, 2022. Then now, if we move a bit more into the detailed features of this market correction mechanism. So as I said earlier, and it has to be really crystal clear for all of us today, is that that price cap will apply to all derivative contracts at the TTF regulated market for product maturities ranging from month ahead to year ahead product. And the triggering conditions are also described there, meaning that if a TTF price does not exceed 180 euro, and on top of that, if the TTF price is rather close to the energy reference price, the cap is not triggered. And what about that reference price, which is a brand new tool or concept introduced by the European Commission in this regulation? That is to say that basically that reference price intends to set by ACER, the European regulator, an average LNG price from a basket of existing and new LNG index. So gathering, for instance, the LNG DS price from the Northwestern Europe, Mediterranean and GKM region as published today by Platts. Also, the similar LNG index issued or published by Argus will be onboarded. On top of that, the NBP price, so for the British gaseous market as published by ICE, will also be considered to build up this reference price. And on top of that, there will be a new daily LNG reference price set by ACER. That new price will stem from a new LNG transaction reporting obligation, which is introduced by the new regulation on the gas emergency measures. And that means that ACER will perform and issue its own LNG reference price, and it will be the fourth component of this set of LNG index, which will build the reference price to which the TTF months ahead will be compared to decide whether the cap price should be activated or not. So that means that the implementation and the activation of the price cap will be driven through a dynamic bidding limit as defined by the regulation itself. And basically, it means that that dynamic bidding limit will be the max value between the 180 euro per megawatt-hour reference value from the TTF market compared to that reference price stemming from the fourth new LNG index plus 35 euros. So that means that, in other words, if let's assume that on 1st of February, if TTF price bounce back and reach 180 euro per megawatt hour, but if in the meantime the LNG price soar up to 200 euro per megawatt hour, meaning that the reference price will be at 200 euro per megawatt hour, there will not be any triggering or activation of the price cap. So if activated, that dynamic bidding limit would be deactivated by default after 20 working days, so after 1 month of application. And after that, it will be also activated if the reference LNG price will be lower than 145 euro per megawatt hour. So 145 euro per megawatt hour plus 35 euros there being equal to the 180 euro per megawatt hour applied for the TTF price. So that means that the dynamic bidding limit could lead to a situation in which the price cap could be triggered for the first day of application, let's say at 180 euro per megawatt hour for day one. And if the LNG price increases like hell in the following days, that means that the cap price for TTF market may increase step by step from 180 euro to 200 or 220 euro, for instance, if the LNG market quote at 220 euro 3 days or 2 weeks after activation of that cap. So this is just to give you a short oral description on how this dynamic bidding limit will work. And in order to fully implement that new mechanism, and notably the check with the TTF compared to the reference price, and also to assess what is the list of regulated market who should be onboarded in this new cap mechanism on top of the TTF. There is some important milestone on the short-term basis to bear in mind. The first short-term milestone will be for next week, 23rd of Jan. For that day, both Acer and ISMA should provide an interim data report concerning the introduction of that mechanism, meaning that by mid next week, Acer and ISMA should provide a kind of impact assessment to assess to which extent that new market correction mechanism as defined will impact the market. And on top of that, are there other regulated market on top of TTF which should be onboarded in this gas price cap mechanism? And basically, and it will be my last slide, is that after this first intermediate report to be issued next week, both Acer and ISMA should issue their final report by 1st of March, and they should propose to the European Commission some kind of decision on the potential extension of the price cap to other regulated hub called virtual trading points, and to see if they should make a proposal to extend that mechanism on regulated market, with a broader scope than limited to the TTF Dutch market. And on top of that, in that report, Acer and ISMA should also make some kind of assessment or analysis on what will be the consequences for the functioning of gas market in Europe if OTC market, over-the-counter market, remain excluded for the cap. So we are subject to some kind of uncertainties by 1st of March to what will be the exact geographical scope of, let's say, regulated market covered or subject to this price cap mechanism. So TTF being the default market as of today, but maybe Acer and ISMA will propose to have a various set of regulated market onboarded. OTC market should be excluded as, let's say, a default rule, but by 1st of March, Acer should provide an opinion regarding the, let's say, collateral effect of such an exclusion of OTC market. And then the outcome of this process will be by 31st of March. At that moment of time, a decision should be made by the European Commission for an implemented act, notably to say to set the list of regulated market covered by the cap itself. And then, as also already mentioned earlier, the suspension of the market correction mechanism by the European Commission, so that suspension into the power of the European Commission can be suspended at any time if introduction or triggering of the cap have unintended market disturbances, as I said earlier, on financial stability of market, cross-border flows, or physical risk with regards to security of supply. And I will conclude on this with the last paragraph. Our NG preliminary assessment with regards to that mechanism is as follows. First, the cap value is still at a rather high level with regards to the gas price, especially considering the gas price we have been noticing now for a few weeks with a downward trends. And then the two condition triggering scheme leads to a quite sophisticated scheme and not easy to implement and to follow for all stakeholders, meaning that that mechanism is not so simple to understand, to master, and to implement, to our opinion. And with regards to the scope of regulated market covered or potentially covered by this new mechanism, considering that today TTF derivative will be by default the only market subject to the cap, there is a risk of significant shift of the trading on derivative market from TTF to uncap over-the-counter market first. And also there is a risk of liquidity shift from TTF to over European virtual trading point regulated market if those over-regulated markets are not capped. And so what we can also notice, and it's a bit worrying for us, is that so far there is an unclear coverage for the over European hubs. So we have to wait in the coming weeks to understand what will be the decision in terms of scope of market subject to that cap. So it can be a source of disturbances on volatility, on the functioning of gas market in the coming weeks. And it's also a very important point is with regards to gas long-term supply contract. The bulk of them in Europe are market index. They can be either TTH index or index to other references such as Heren, Argus, or Platts indexed. And it means that the application of that cap rule may have some collateral effect on existing gas supply contract, meaning that if a long-term supply contract is TTF index, the price of the long-term supply then may be subject to the cap if the cap is triggered. And even for other contracts subject to other indexation, the effect, the collateral effect of that cap should have to be monitored with care, not only for the functioning of the market, but also with regards to the potential consequences of the price formation to the long-term contract and to the potential issue it may raise in the life of those contracts, depending on the clauses signed between the two counterparts of that contract. So that's it from my side. And Julien, I don't know if there are some, I guess, or maybe there could be some questions on these topics.
Yeah, thank you, Cyril. Yeah, of course, there are questions about this major regulation piece. First one concerning the LNG price preference. So Acer said they were not able to assess the LNG benchmark over the past few days. Does that mean that the cap will never see the light of day?
Yeah, that's a good question and a fair point to notice. Indeed, Acer was supposed, as from last Friday, to issue a daily LNG benchmark, but it failed due to the fact that Acer was not able to gather enough transaction from the market participants so far. So our understanding is to say that this new publication of Acer Daily Index will follow a stepwise approach. So even if in a regulation there was some very ambitious deadline set, especially for Acer to issue that benchmark, what is very important is to be able to issue a reliable benchmark, otherwise it's useless. And that means that as that publication of this LNG benchmark required for Acer to fully implement the new reporting process of LNG transactions, that process will take time. So meaning that the daily publication from Acer will take some time, but it does not prevent for, let's say, on the midterm basis, for the entry to force of the cap itself. So that means that I will not make any expectation in terms of deadline, but what we can reasonably expect that within a few weeks, I don't know, let's say by end of February, ESR will gather energy transaction enough to be able to issue its daily energy index. And that means that application of the cap may be possible in February within a few weeks. And in terms of process-wise, let's say the issue ESR face these days will be solved within next weeks probably. But it will be let's say gradual or stepwise approach, definitely.
Okay, we have time for one last question before switching to the last part of the presentation. For the suspense of the cap, how these risks are evaluated and on which temporal basis, for example, intra-European gas flows?
That's a good question because the answer is not easy at all to guess, because it has to be that answer has to be provided by ESR, meaning so. Next week, on 23rd of Jan, we will be provided with a first flavor from ESR interim report on how we handle this kind of evaluation or risk assessment. And so it's not an easy job, definitely. And with regards to temporal basis, I think that so far the risk with regards to, let's say, interconnection flows within the European gas system will be highly dependent on the exact set of regulated market which ESR will propose to cover as part of the cap. So meaning that the story is not the same at all, whether you consider that only TTF is capped, or if you onboard over regulated market, over a virtual trading point in the scope, it's not the same story at all. And so the impact with regards to intra-EU gas flow completely changed. So not easy from my side to answer to that question, but this is a very fair point, and it's up to ESR to give us some indication on this. Firstly, next week, 21st of Jan, and then with the final report by 3rd of March or 1st of March.
Okay, thank you, Cyril, for these presentations and all your answers. So it's time to move on to the last part of this presentation with Hélène.
Hello. Yes.
Hello, welcome. You can start.
Okay. Good morning, everybody. So I'm here to give you some updates on the latest move on the European power market regulation. So obviously the last months have been very busy with regulatory activities. So we will first take a look at what happened in the last, let's say, 6 months, and then some views on what we expect for the upcoming weeks and months. So looking back at what happened since summer 2021 in a nutshell, you see on these graphs the evolution of the Cal+1 power prices and gas prices. And obviously, you can see that since summer 2021, the prices have been increasing. Below the charts, you can see various initiatives, papers, statements, communication from the European institutions. So it started last autumn, in autumn 2021, with papers from ESR alerting for the high energy prices. And of course, we will not go through all the statements and paper, but the idea here is that you have to realize that politicians and European institutions are working on the topic for a while now, with various ideas that have been brought on the table. So some member states came with proposals to reform the electricity market design. And at the end of the day, what happened, or the only, let's say, very concrete and real regulatory proposition has been decided at the end of 2022. It's the famous Council regulation that we will discuss in a moment. So after many tentatives, many texts, many position papers, many discussions, finally the Council regulation has been adopted, and it has been adopted, so as I said, in autumn 2022, so last autumn. It's an urgent regulation that has been adopted in order to address the problem of very high energy prices. You have to know that it is based on an article of the Treaty of the Union that gives power to the Council to adopt regulation in case there is an emergency. So it's really an emergency regulation. And this Council emergency regulation has four pillars. The first one is a coordinated electricity demand reduction. So you have two targets, one on the monthly consumption, which is indicative, and one on the peak hour consumption, which is binding. So everyone, all member states, had to put in place measures to reduce their peak consumption, or the consumption at peak demand. The second element is the famous cap on infra-marginal rent, and on that one we will spend a bit more time in the next slides. The idea is to limit the revenues of infra-marginal power plants, but we will see in the next slide how it is built. The third pillar is measures to support consumers. So the idea is that this regulation is broadening the scope for member states to intervene either via a regulated tariff, but also via other targeted measures to support consumers. And last but not least, there is an extraordinary tax, although it's called contribution, because as such European institutions do not have the right to impose taxes to member states. But there is this solidarity contribution from oil, coal, gas and refinery sectors. So member states are asked to capture some extra profits from those activities. On our side, we will focus on the second pillar, so the cap on the infra-marginal rent. So how does it work in a nutshell? The idea is that Europe is setting a limitation on the market revenues for producers. So for all those units that are called infra-marginal, so that are producing at a cheaper price than the marginal units, so the marginal units being the latest units we need to meet the demands at a given moment in time. So all those units represented here by the green block and the yellow block, so mainly renewable assets and nuclear assets, they are having a limit on the money they can make in the markets. So it's represented here by the red block. So there is a limit set to 180 euros per megawatt hour to the revenues that those units can collect in the markets. And so this red surface, this red block, is to be collected by the member states and has to be used only to finance support measures to customers. So it's forbidden for a member state to use the money to finance anything else than measures to help consumers to pay their bill. It is an obligation to member states, so Europe is imposing that to member states. Of course, or maybe unfortunately, member states have the possibility to go beyond or to do more than this base case provided by the regulation. So a country may say, in my country, the price limit is not 180, but it's 100. So it's really up to each member state to implement more than the base case. what is quite difficult is that, as I said, the implementation is done by all the member states. So it's not a uniform or an harmonized measure. So it can lead to distortion or to unfair competition if market participants are not subject to the same rules in the different European countries. So this is the cap on infra-marginal rent. It is supposed to apply from December 22 to June 2023, but there are possibilities to further extend the application of this measure. So that's for the Council regulation that was voted last autumn. Another very important topic that is being discussed on the regulatory domain is the famous price cap in day-ahead. So you heard my colleague Cyril talking to you about gas price cap. So in the day-ahead markets, in electricity, there is a technical price limit, a so-called technical price limit, so acting as a price cap. The background of this is the electricity regulation that says that basically you can't have any cap, so that free formation of prices is allowed in the electricity markets. However, for algorithmic perspective, of course, you need to set a limit. And this limit is set by a technical methodology that has been decided by Acer some years ago, that was setting the price at 3,000, but there is a possibility that this price cap increases by step of 1,000 when the price in 1 hour is reaching 60% of the current cap. This has been hit 2 times in 2022, 1 time in April and 1 time in August in the Baltic. After the second hit, so at that moment the price cap was 4,000 following the first hit, the power exchanges decided to not implement the plus 1,000, so to not go to 5,000. At that moment, there were many debates and discussion between the member states, the Commission, and the Council, whether or not there was a necessity to freeze this price cap or even to lower it as a temporary emergency measure. But this has not been retained by the European Commission. What happened, however, is that Acer requested the Power Exchange, so NEMO stands for Power Exchange, to propose an update of the methodology, which they did. And then, as usual, Acer took this proposal and made their own decision. So they just recently, a few days ago, decided on the new methodology, which sets the initial cap at 4,000, so let's say the current situation, and still gives the possibility to have increases, but by steps of 500 euros instead of 1,000. And it sets much more inertia to the system, because the price has to reach 2 times the threshold of now 70% instead of 60% in at least 2 different days within 30 rolling days. So you need really to have 2 spikes to have a price cap increase. So that is now in place. So this is really what is being discussed on price cap for electricity in the day-ahead markets. And so what happened next, to conclude? Actually, these days, we expect the Commission to launch a market design reform. So let's say targeting medium term, so let's say 3 to 5 years ahead. They are supposed to launch a big consultation. It was supposed to be launched before or at around Christmas, but given some apparently misalignment between the Commission and some member states, it has not been launched. This consultation may target 4 pillars, going from the famous idea to decouple the consumer price from gas prices. So basically to have less influence of gas prices in the end user bill, to promote the efficient or the increase of renewable investments, and to boost the energy efficiency. The possible adoption would be 2023, March, but we expect some delay because the consultation has still not been launched yet. So what are the key elements on our side that we think we should focus on? The overall perception, I think this idea is broadly shared in the sector, is that the wholesale short-term markets are working very well, which means that they allow to have an efficient dispatch to activate the best units at each moment in time, and to ensure the right cross-border flow determination, so to ensure that the flows between the countries are well established in an optimal way. However, what we think is that massive investment will be needed to ensure the political ambitions for decarbonization, so both in renewable production but also in the grids to manage the congestion. So what we need is to complement those short-term electricity markets with efficient tools to ensure efficient investment and congestion management in a market-based way, so that the right price signal are sent to investors and create a good climate for investment. That is really, really key, and we hope that the focus will be put on that in the upcoming debates in the upcoming months. So that's it on my side. I'm okay to take questions if we have time.
Yes, thank you, Hélène, for your presentation. Yeah, we have some minutes for a question. Stay with us. I will just launch the satisfaction survey and will answer the question during the survey. So, I would like to thank you all for your attention, and please, if you can fill this satisfaction survey, it's very important to have your feedback. It's always valuable to us. So, a question for you, Hélène. What is in scope for adoption in March 23, which can be possibly delayed? Is it a full market reform and legislation adoption for all member states? It sounds unlikely, as previous market reforms took several years. Can we expect something concrete to be installed before mid-23?
Okay, very good question. First, I think that March 2023 will be delayed to May, June, or even maybe after summer. And for me, what will be adopted is only ambitions, so action plan or ideas. Of course, nothing concrete would be installed before end of 2023. What I expect is that if there are agreed ideas on what to do to improve the markets, those ideas would be adopted as an action plan. So it could be we all agree in Europe that I don't know, capacity mechanism should be reinforced or should be favored by member states to better organize the adequacy in the different countries, and member states have X years to adjust to the new legislation. But I certainly do not expect something very concrete and up and running in 2023, rather agreed, let's say, plan or ambitions. So I hope that answers the question. And yeah, to complete, we hope that the idea that the short-term electricity market function well will be shared by all member states, and that those will be preserved. But we have we hope that that this idea will be indeed shared. At least on our side, we will promote it.
Okay, thank you, Hélène, for your answer. I'm closing the satisfaction survey, so thank to those who took the time to answer. It's now time to close this session. Do note that the next webinar session will take place in 3 months, in April 2023. So have a good day and see you soon on EnergyScan. Goodbye.